Hello, in this lecture we're going to work a tax problem in which we will calculate the tax basis in a simplified model. We're going to start off opening the partnership in this case, put in the first year of information, and then in the second year we're actually going to close up the partnership. So it's kind of a sad story. We're going to start it and then close it in year 2, but we'll get to see the learning process of it, which will be the fact that we'll see the creation of the capital accounts. We'll take out a loan and look at the difference between the capital account and the basis, tax basis when we see that loan, and then we'll close it up and look through the closing process in terms of both bookkeeping and the adjustments that would need to be made for the adjustments to the capital account. Now, when we think about the capital account, we think about most problems in textbooks as well as you look at regulations in the tax code, usually going to be calculated in terms of a table. And as someone that works with trial balances and accounting with the background more than tax when I first started, I like to see things in terms of a trial balance as well. I think it gives like the big picture view. So we're also going to put it in terms of the trial balance, meaning we're going to have the beginning balance, which will be zeros. We're going to have the book balance, which is kind of on the inside tax basis in this case, because if you're not publicly traded, you could basically tie yourself out to something that might not be exactly generally accepted accounting principles. Otherwise, you would need a book basis and then go to the inside basis. And then we'll make the adjustment for the outside basis, basically the tax basis, and try to give some comments as to why that would be necessary as we go. And this is going to be one difference we'll have between the two based on loans, and we'll see kind of why that would happen. All right, so we're going to have the information over here. We're going to make the journal entries. We're going to make the adjustments and post them to this information over here. Now, we're going to do this pretty quickly, so if you have any questions on how to post or anything like that, then go back to some prior instructional videos and I'll show you how this kind of worksheet will work out just from a bookkeeping standpoint. Alright, so partners contribute cash to the partnership, 100 each. So we got A, B, and C being the partners. Here's their capital/basis accounts over here. So if they each put $100 in, cash is affected, cash is going to go up. So I'm going to make it go up by doing the same thing to it, which is a debit. So journal entry wise, it would be a debit of $300. Each of them put in, whoop, not 3,000, 300. And then these three partners, I'm going to copy these three partners. I'm going to highlight these three, right click, and I'm going to copy those. And I'm going to put them right underneath and right click. I'm not going to paste this. I'm going to paste 1, 2, 3, just so we have the values only. And we could indent them, home tab, alignment, indent. And I'm going to represent my credits with negative or bracketed numbers for formula purposes. So negative 100 for A, negative 100 for B, negative 100 for C. Debits equal the credits. If we highlight the positive minus the negative numbers, it equals 0. Therefore, we're in balance. Let's post it out. We're going to post it out over here to the adjustment area. So I'm going to say cash equals the 300. Cash goes up. Same for the book. Same for tax basis. So that doesn't need to change. We don't need any other adjustment here. If we look at the capital accounts, we're going to say this equals the 100 for A. This equals the 100 for B. This equals the 100 for C, and we're back in balance here. No effect on net income. And again, the basis is the same in both. So there's no difference at this point between the book basis and the tax basis. So then we have 2 says, partnerships takes out a loan. So that's not going to be enough capital in order to run the business. So let's say we're going to take out a loan at this time for, in this case, $90,000. So we're going to get cash. Cash is a debit. We're going to make it go up by doing the same thing, which is another debit. So we'll debit the cash for this $90,000. We're going to have to credit something for $90,000. Debits need to equal the credits. We're going to represent the credits with bracketed numbers in this worksheet. And then the credit's going to go to the loan in this case. So I'm going to copy that. Going to paste that down here. 1, 2, 3. Paste it 1, 2, 3. And we could indent the credit if we want. Alignment and indent. And if we post that out, then I'm going to go to cash. I'm going to double click on it, go to the end of it, plus there's the 90, bringing the cash up to 90,300. Same for the book, same for taxes, no adjustment needed. On the loan side, here we're going to be down here in the loan, the credit equals the 90,000 and enter. Now, here's where the kind of issue happens, where one difference happens between the capital accounts, because now if we're a general partnership and we're saying that these partners have personal liability on these loans, then their basis should go up by their share of the personal liability on the loan. So that's going to be the difference here between, in this case, the kind of book numbers and the tax numbers for tax basis. So if we think about that, we're going to say, okay, with those three partners, they're all on the line for the loan, and therefore they should get their basis increased. And it's a good thing to have your basis increased, because then if there's losses, you can, it's generally could take advantage of those. So you're going to have to increase the basis. Now, if you think of that with a journal entry, then we'd have to make maybe another capital account in here just to balance it out. So we're going to say, okay, there's three of them. So these three need to increase their basis. So I'm going to copy those three, and I'm going to paste it down below to put the credits down below. Increasing their basis. Basis has a credit balance. We're going to increase it with a credit. And what's the credit going to be? I'm going to make it a negative to make it a negative number, 90,000 divided by 3. So they're all going to get a 30,000 increase in their basis over on the tax side over here. So that means that there's going to have to be a debit to something if we're going to balance this out. And this is just going to be our reconciling entry. I'm just going to put it right here. This is the tax adjustment. This is the reconciling entry in order to give them credit for the increased basis. So I'm going to copy this and paste it right here. That's going to be the adjustment. So if we posted that, that's going to be over here in the tax basis. So I'm going to say this equals the 90,000. And then we're going to have the table over here. So we're going to say the A's capital account is going to go up by 30. So it went from 100 to 30,100. And then B's capital goes from 100 to 30,100. And then C's goes from 100 to 30,100. So that's going to be an important difference, of course, between the two. If you looked at it the way most problems will look at it, it'll be a table, right? If we look at the table over here, we would say, okay, what happened? First, there was a $100 contribution by A, B, and C. No adjustment at this time. That means that the sum of the total of the capital accounts is the 300. There's the 300 right there, summed it up, 300. These are debits and credits. This is just a positive number calculating the capital accounts. Then we got this loan that we allocated out. So if we're going to allocate this loan out, remember that was equal to 90,000 divided by 3. So A gets 30,000 allocated to their capital accounts, and it would look like this. We would then need, if we wanted to tie this table to the book adjustment, we would have to say that there's an adjustment of this 90,000, right? And that would be the amount that's going to adjust back to the book number. And so the total to the capital accounts wouldn't be anything to the capital accounts. The capital accounts are still 300. Capital accounts are still 300, but the basis accounts for tax basis are now here, adding up to 90,300. So that's going to be the difference in terms of a table as well as in terms of just posting this in a trial balance format. Okay, so then we got the purchased equipment for cash. So next thing that happens, we got that cash. We're going to purchase some equipment for cash, 60,000. So we're going to say equipment goes on the books. Equipment's an asset. So I'm going to say assets are going to go up. Paste that here, and it's going to go up by that 60,000, and we paid cash for it. So I'm going to copy the cash, put that on the bottom. Cash is going down. Cash is a debit. We're going to make it go down by doing the opposite thing to it, which is a credit, and that's going to be a negative 60,000. So here we have the purchase. We could indent these if we want. Home tab, alignment, indent. We could have done that to these three: home tab, alignment, indent. And we can post this out now. So I'm going to scroll up. Equipment in T7 is going to equal the 60,000. Equipment goes up. Cash is going to be here. I'm going to double click on it. Something's in it. Going to go to the end of it and plus and have this credit. So there's a credit. It's going to make cash go down 30,300. No difference here between the two methods, the tax and the book. So we are okay with that. Purchase inventory. So now we're going to take our money and purchase some inventory. So we're purchasing inventory for 15,000. So 15,000 of inventory. So we're up here in inventory. Inventory is going to go up. We're going to purchase it on account. So I'm going to deal with the inventory first. We're going to copy the inventory, put that on top, right click, paste it, 1, 2, 3. And we're going to purchase 15,000 of it. Then we're going to credit something. So I'm going to have a credit for 15,000. Now we're not going to pay cash in this case. We're going to put it on account with accounts payable. I'm going to copy accounts payable, put it right underneath, and right click and paste it 1, 2, 3. I'm going to go ahead and go to the Home tab, Alignment, and indent that as well. All right, going to post this out. So we're going to go to T6. We're going to say what happens to the trial balance. Inventory is going to go up by 15. The accounts payable is also going to go up in the credit direction. So I'm in T8 equals the 15. So the account payable also goes up. And this is a difference between the loan. Notice that when we did this on the loan, we then allocated to the capital accounts over here for their basis in the liability. Not so for the accounts payable. So keep that in mind as when you're thinking through these problems. I'm going to go ahead and unhide some cells. So I'm going to highlight these. I'm going to right click on them and unhide those cells. We're going to work in this area for the next piece of the problem. Therefore, I'm going to hide these cells. I'm going to go to J, going to go to C, or whatever that cell is, and right click and hide those cells. Scroll back over. We don't need these either, so I'm going to highlight these cells and maybe the E2. I'm going to highlight these. Right click and hide those. All right, so then we can take a look at the next transaction and we'll have everything side by side here. So we had a sale for 10,000. So now we sold on account 10,000 was what we received, cost 7,000 of the inventory that we sold. Okay, so we didn't sell it for cash. We got an IOU, that's accounts payable. Accounts payable is going to go up. So I'm going to copy the accounts payable. I'm going to right click in F4 and paste it 1, 2, 3. It's going to go up by the 10,000. Then we're going to credit something for the 10,000. And the credit related to the receivable is going to be sales. We'll talk about the inventory separately. I'm going to have 2 separate journal entries. So we're going to copy sales. We're going to put this up top, right click, paste it 1, 2, 3. Going to highlight that, Home tab, Alignment, Indent. So I'm going to post this out and then do the other half related to the inventory that we gave up in order to get the sales. So we're going to say accounts receivable. I'm in T5 equals the 10,000. We're going to scroll down to sales down here in T14 equals the 10,000. That puts us back in balance. We have income now, sales, net income, 10,000 income, not a loss. That's just our sales item there. Then we have the inventory is going to go down because we had to give up the inventory in order to get the money on the sales, or at least the receivable on the sales. So inventory is a debit. We're going to make it go down by doing the opposite thing to it, a credit. We're going to copy the inventory. We're going to go down here. I'm going to put it on the bottom, right click, paste it 1, 2, 3. It's a debit account. We're going to credit it to make it go down by 7,000, the cost given 7,000. We could indent that, Home tab, Alignment, and indent. Then we're going to debit the expense, cost of goods sold. Copy that. Expenses have a debit balance. They always go up pretty much. So we're going to debit it for the 7,000. And if we post this out, then if we go to the T15 equals the 7,000, that means our net income went down to 3. 10 minus the 7 is 3. That makes sense. And then we're going to go to the inventory, double click on it, go to the end of it, plus the inventory. The inventory is going to go down from 15 down to 8 at this point. Okay, so next thing that happens is we're going to close out the year. So we're going to say that that's all the activity that happened in year 1. We're going to close out the income statement. So remember, these are temporary accounts. We're going to close this out. And then in year 2, we've decided basically to close up the company. So we're going to close everything out this period. Then we're going to go through the closing process next time. So in order to close out the income statement, I'm going to do this in a bit quicker way. I'm not going to close it out to the income summary. I'm just going to say, hey, sales has a credit balance. We need to do the opposite thing to it to make it go down. So I'm going to debit the sales for whatever's in there, 10,000, 10,000. And then cost of goods sold has a debit balance. We need to make it go down. So I'm going to do whatever we got to do to make it go to 0. Credit 7,000. And then, I mean, if I was to add this up, we've got 3,000 here. 3,000 that is, we're going to need a credit in order to be in balance, right? 7 plus 3,000 is going to be a credit. We have 3 partners. We're going to say that they share the profit and loss evenly. Therefore, they're each going to get 1,000 of that credit. So I'm going to copy that to put it in balance. Right click, paste 1, 2, 3. We're going to allocate the income to the 3 partners, 1,000 each. Now you could do that with a formula. We could say negative sum of these. I want to take this minus this, then flip the sign. This minus this would be a positive 3,000. We want a negative 3,000 for a credit. and then I want to divide that by 3 partners. And that would give us the 1,000. Want the same 1,000 here, same 1,000 here. Debits 10,000 equals 7 plus 1 plus 1 plus 1. 10,000. Debits minus the credits equals 0. We are in balance. Let's post it out. We're going to go to sales. I'm going to double click on sales plus the 10 and brings it to 0 because we're closing out the temporary account at the end of the period. And then here's the 7,000 plus the 10. We closed out the cost of goods sold. We're going to take that to the capital account. So double click the capital plus the 1,000. Capital goes up to 1,100. Double click the capital plus the 1,000. Capital goes up 1,100. Double click the capital. Capital goes up by the 1,100. So that's the first year of operation. If we were to look at that in terms of the table over here, because notice the difference of what we have. We've got the capital accounts here are much different than the capital accounts here. And that's because of that one allocation of the loan allocation. And if we were to just put that in a table, we can do that table wise. The income got distributed of 1,000 each. So it's equals 3,000 divided by 3. 1,000 to each partner. In terms of a table, there's no adjusting process. So if we were to sum that up, that's what we have in terms of the running balance for the adjusting column. Brings us back to the capital account, which is here, 3,300, 3,300. This is just a running balance. And then, of course, our capital accounts are here in terms of a tax basis. So here's the tax basis. Here's the book basis. Here's kind of the reconciling items that are happening. Here, the reconciling item is basically that loan that got allocated out. Here's the actual allocation. So that's how you can represent this difference and try to see it in terms of posting it out and see when they happen in terms of balancing and journal entries. Next time, we're going to go forward to year 2 and go through the closing process. So we're going to start the liquidation process next time.